ครับสวัสดีครับ Good morning. And first of all, thank you so much for the Stock Exchange of Thailand for inviting Thai Oil to join the SET Digital Roadshow for Q4 and full year 2018. Before presenting, let me introduce the panel from Thai Oil. In the middle, we have คุณธาริกาเทพหัสดิน อยุธยา Vice President Financial Planning.And on the right hand side, we have คุณชุริยนต์เลียงรื่นรม Assistant Manager Investor Relation and myself ชัดชัยศิริวิทย์ Investor Relation Manager. The presentation today will cover mainly three parts. The first part will be about the company, a brief company introduction and also the key highlight of 2018.And the second part will be go into more detail about the financial performance of the Q4 and 2018. And last part will be the market outlook for the key industry that Thai Oil operate in, including refinery, petchem, and lube based. So all presentation will be within 45 minutes. So we can start with คุณธาริกา on the first part.
Okay, let me start about the Thai Oil Group business.Structure. Okay, this one I will start from the left hand side of the slide. It's about the oil refinery. Our oil refinery, we have the capacity around 275 barrels per day. That the main production we produce middle distillates is around 60%, and around 30% we produce gasoline. The gasoline, half of that is a feedstock to the aromatic business.And for the heavy product, like a fuel oil product, it will send as a feedstock to the Thai lube based or TLB. For the aromatics production, that we have the Thai paraxylene, we produce the aromatic capacity. The PX production is around 500 ton per annum, and for the benzene is around 259 ton per annum. The total is around 838,000 ton per annum. And for the lube base oil, we have the lube base oil capacity is around 267,000 ton per annum. And also we have the specialty like TDAE. This is a non-toxic rubber that is make our good margin for the Thai lube base.The first part of the refinery, petrochemical and lube base contribute the net profits is around 80%. The 50 to 60% is from refinery and around 20% from aromatics, and for the 10% is from the lube base oil. Moreover, we also derive the profit from the power generation plant around 15%. Our generation plant has the total capacity around 357 megawatt for electricity and around 700 ton of the steam per ounce. Those are from our Thai Oil Power and the Top SPP. We also engage the power business through GPSC as an associate company, which currently we both direct and indirect interest of 24%. And for the last 10% or the less of 5% is from the other business like marine business and ethanol one. Then I will move to the key highlight. What happened in the 2018?We can see that from the refinery side, we have the market GRM is around $44.7 per barrel. This one is a softened from the 2017, which report around $6.7 per barrel. The main reason is because of the two factors. The first one is a crude cost. We have the higher crude cost due to the crude premium of Melbourne and Dubai that increased during the year. It is increased from $1.7 per barrel to $2.1 per barrel last year. And another one is a softened refinery margin, especially from the gasoline that reduced around $20 per barrel in Q4.It's reduced around $7 per barrel in Q4. That make the soften to our GRM. Moreover, for the Dubai crude cost, the Dubai actually the level is softened from the year 2017. That make our stock loss around 40 cents. The main reason is because of the high production in the US and also the waiver of the import Iranian crude by US too. And for the second business of the aromatics actually we got a better contribution from TPX. It's a contribution around $1.8 per barrel improved from the year 2017. That because of the strong PX spread that support by the tight supply from the startup of the Petrolabic and Nissan is not fully capacity, and also the robust of demand from the downstream product like PTA and polyester. But for our lube-based business, we have the softened contribution from lube business. It's because of the additional supply from the new capacity from both Saudi Arabia and China. So all in all, the GIM of the business from last year is softened to $6.9 per barrel, and we have the stock loss $0.3 per barrel. The accounting GIM we report 6.6 that are softened from the year 2017. So that from the softened GIM that the market that I said, we can see that our net profit for last year we record the net profit of 10,149 million baht. That are lower than 2017, but we also have the key achievement that we do a lot of things in the last year. We also maintain the high reliable production. We also run the plant for refinery, for the aromatics and base oil in the high rate to capture the market of local and Indochina. You can see that the percentage of the market of the sales share to those regions is still maintained high. Even last year we have the major turnaround of the CDU1 for the refinery. And moreover, in August last year, we also have the approval from EGM, which approved our big project, CFP project. It's a clean fuel project, which is the investment cost is $4.8 billion. That we got the vote around 99%. And also in the same year, in October, Thai Oil also signed the EPC contract with the consortium of 3 companies now, that are Saipem, Petrofax, and Samsung. Yes, and we expect that our CFP will be COD in 2023. And for the another thing is that I would like to point out is about the sustainability. This one we also got the sustainability member for oil and gas industry for the 6th consecutive year of DJSI emerging market. And also last year we also get the award of the best company performance award 2018 from the set for the company in the market share over 100 billion. Yes, so I will pass on the performance by Kun Churiyon.
For the financial performance in 2018, I will focus on 3 main business units: refinery, aromatics, and lube-based business, and also focus on the key highlight in financial statement. Let me start with refinery performance. In terms of utilization in the upper left, in 2018, we still maintain our run rate at high and reliable level at 113%, even though we execute the major turnaround for CDU number 1 in the second quarter, and comparing to the industry average at 97%, our run rate is still higher. And the reason why we maximize our utilization rate is that we would like to satisfy the growing demand in Thailand. As you see in the upper right, the oil demand is still growing year on year, with the total growth 2.6%, led by the jet fuel demand growth 5.4% and gasoline and diesel. And in terms of commercial side, we still focus on the domestic and CMB market. In 2018, we sell to local 86% and sell to CMB country, Cambodia, Laos, Myanmar, and Vietnam, another 9%. And only 5% we export to other countries like Singapore and Hong Kong. And in terms of customer sale breakdown, PTT purchase account for 46% of total sale, and we also have domestic customers like PTG, Shell and Chevron, and Bangchak as well. And in terms of gross refinery margin or GRM, in 2018, we reported GRM at $4.7 per barrel, lower than the previous years at $6.7. And the lower GRM is mainly because of the higher crude premium, like Kun Tarika said. And another reason is that the gasoline spread was very weak last year, especially in the last quarters. The reason is that the US still pump a lot of gasoline into the market, while the global inventory is still high. But if you look at the middle distillate spread, diesel and jet fuel, both spreads was stronger, supported by the fundamental factor. Inventory was very low and the demand still growing. And in terms of crude price, average Dubai price in 2018 was $69 per barrel, higher than the previous years. However, if you see the monthly Dubai price in 2018, the price coming down toward the end of the years. And you will see that the price in December 2018 was $57 per barrel, was a bit lower than the price in December 2017 at $62 per barrel. So last year we had a stock loss at $0.4 per barrel, or around $40 million. And so overall, last year we had a GRM at 4.7 and stock loss at 0.4. So accounting GRM was 4.3, lower than the previous quarter, lower than the previous year at 7.6. And for next business unit, aromatics business, I would say that in 2018, it was a good year for paraxylene or PX market. As you see in the chart, the PX spread over ULG 95 in the dark blue line. The spread shoot up since August last year, and right now the spread is still above $500 per ton. And this is because of the supply tightness due to the unstable operation of the new plant in Saudi Arabia and Vietnam, and also supported by the good downstream demand like PTA and polyester. And also the weak of gasoline is the one reason that helped the PX spread that widen as well. And in contrast of benzene, the spread was very weak last year, mainly from the benzene oversupply situation. And so overall, aromatics performance last year was stronger, and it contributed to Thai Oil Group $1.8 per barrel. And also aromatics production increased to almost 90% as well. And for the lube business, the performance was softened last year, mainly because of lower lube-based spread that pressured by the new capacity coming in the market. And the contribution to Thai Oil Group last year was $0.5 per barrel, lower than previous years at $0.8 per barrel. And in terms of production last year, lube-based run 84%, a bit lower than normal operation because of feedstock problem during the third quarter. And another product line that can help strengthen our main business and also contribute profitability to our group is power business unit. And in 2018, power business contribute around 2.1 billion baht, comprised of 1.3 billion baht profit from our own SPP, Thai Oil Power and Top SPP, and another 800 million we recognize profit sharing from GPSC, which we hold around 24%. And in terms of margin and cash cost, I will start from the left side. In terms of margin with the business line combined, refinery, aromatic, and lube base. So our gross integrated margin in 2018 was $6.9 per barrel, or $6.6 per barrel with stock loss included. And in the meantime, refinery cash cost in the upper right, refinery cash cost was 1.4 for operating cash cost and 0.4 for net interest expense. And I would say that $1.4 per barrel for refinery cash cost is considered as a competitive level compared to other refineries in the region. Thai Oil Refinery is in the first quartile in terms of lower cost. And in terms of group cash cost, last year it was $1.9 per barrel for operating costs and 0.5 for net interest expense. And in terms of performance breakdown by business unit, last year we reported net profit 10,149 million baht, and mainly 75% of net profit are mainly from main business unit, which is refinery 40%, aromatic 25%, and lube base 10%. And another 20% is from power generation, and the rest 5% is from other business like solvent, marine, and ethanol business. And for the consolidated profit and loss, I will focus on the key figures. In 2018, we had EBITDA 20.2 billion baht, softened from previous years, mainly due to the lower GIM from higher crude premium and weak gasoline spread. And for the net profit, we reported 10.1 billion baht with the stock loss and NRV at 2.6 billion baht. So net profit excludes stock loss and NRV was at 12.7 billion baht. And for the earning per share last year was 4 baht 97 stang. And lastly, the effective tax rate last year was 16%. For the cash flow over the years, start with the beginning balance, 71 billion baht. First activity, net cash from operation, 18 billion baht. And the second activities, cash used in investment activities, 25 billion baht, mainly consists of short-term investment, 21 billion, and capex used, 7.7 billion. And lastly, cash derived from financing activity, another 25 billion baht, mainly from the bond issuance, $1 billion, or around 32 billion baht equivalent, and dividend payment around 11 billion baht. And so overall, net cash with all activity, ending balance last year was 107 billion baht, or around $3 billion equivalent. And in terms of asset side, at the end of last year, our asset reached 268 billion baht, with cash on hand and short-term investment around 107 billion. And this high portion of cash on hand, we tend to reserve for CFP, which have the due to pay quite big in these 2 years, total around $3 billion. And on the other side, the long-term debt increased to 104 billion baht as well, because in November last year, we issued a dollar bond, $1 billion, comprised of 400 million with the tenure 10 years, and $6 million with the tenure 30 years. And in terms of cost, cost of debt last year was 4.8%, and by offsetting with saving account, so net cost of debt reduced to 2.8%. And from this strong financial position, even we issued a new bond, the credit rating agencies still maintain our rating at the investment grade. And lastly, in terms of dividend payment, According to our policy that we will not pay less than 25% of our net profit, but from historical data, we normally pay around 40 to 48% dividend payout. And last month, our board of directors approved the dividend payment for 2018 at 2 baht 65 stang per share, or dividend payout around 53%, or dividend yields around 3%. And in September last year, we paid the interim dividend 1 baht 50 stang. So the rest 1 baht 15 stang that we will pay by the end of this April after the AGM approval. And that's all for the performance.
And for the last part, let me go through the key market outlook for Thai oil. And as Kun Tharika mentioned earlier, that for Thai oil, the three main industry that we operate in, including refinery, petchem, or the aromatics chain, and also the lube base. And basically, refinery account for 50 or 60% of the bottom line, and then aromatics another 25, and lube base another 10 to 15. So that's all the three main market that we focus, and we will give a view on the market outlook that we see on this market for the first half this year. We can start with the refinery market on the crude oil market first. So the crude oil that we focus on is the Dubai price, which is the main crude that we purchase, because for Thai oil 70% we purchase crude from the Middle East, and the price mostly linked to the Dubai. So that's why we focus mainly on the Dubai oil price. As you know that at the end of last year, oil price went down significantly. But I would say that from the beginning of this year until now, we see the gradual recovering of the oil price due to the two main factors. The first factor is due to the tightening of the supply, given the Opec production cut and also the lower production from Iran and Venezuela following the US sanction. On top of that, amid the limited supply, the global oil demand still growing pretty well. Therefore, in terms of the balance, oil market become more tightened in the first half, of which I will have more figures to elaborate on in the next slide. So this slide basically show you the supply, the global supply that become more tightened in the first half of this year. We have the figure A showing the OPEC production, and the recent number in January, the OPEC production actually came down to around 26.1 million barrels per day, dropped from a couple of months before. And at the level of 26 million barrels per day is pretty much close to the target level, which is around 25.9 million barrels per day. So the OPEC actually cut the production based on the deal that they announced last year. On top of that, the production from Iran and Venezuela also coming down constantly due to the sanction from the US. So given this three main production cut, overall supply in the market is quite limited. And if we look at the summary in terms of the supply, you look at the figure A, you can see that despite the incremental production from the US on the non-OPEC side, which we expect to increase around 2.2 million barrels per day, we have the OPEC cut around 0.7, and we also have other non-OPEC cuts another 0.6. So all in terms of the net supply addition in the first half this year was only 0.9 million barrels per day. And if we compare this figure to the demand growth, which is on the figure B, you can see that the oil demand growth still growing around 1.4 million barrels per day. So all in with the demand growth outpaced the net capacity addition for the crude oil. So we expect in the first half that the crude oil market to become more tightened, and the crude price, especially the Dubai price, should move to around $60 to $65 per barrel. And right now, I think Dubai is moving around $65 per barrel. I think that's the view that we see for the first half this year. Oil price will gradually increase from the end of last year, given the tightened market that we see. And moving on to the refinery market, so we can start with the benchmark gross refinery margin, which is the widely monitored refinery margin in the regions. And you can look at this Singapore benchmark margin as the indicative for the Thai oil margin as well. It normally is moved in the same direction. So based on the number, the recent number for the Q1, the refinery margin continues soft from Q4 last year and mainly pressured by the gasoline spread. As you can see from the table on the bottom left, the gasoline is the only product that pressure the refinery margin. While on the other products like jet fuel and diesel, the margin still hold up pretty well, and we have more information to elaborate about the outlook of this product and also the refinery margin. But to make long story short, given the low refinery margin in Singapore at the beginning of the year, now we see the refinery margin to start to recover, especially from end of February until now. Mainly from the gasoline market. I think the key point to see from this slide, if you look at the figure A, in terms of the global supply of the gasoline market, is still oversupply situation as reflected in the inventory level in the red line. Is still on the high side. That's the negative factors. But from March onward, we start to see some recovery due to the global refinery maintenance that will start from March until June. So we expect the gasoline supply to seasonally coming down over the next 3 to 4 months. On top of that, we have the seasonal demand coming in, especially from the US, from the US driving season. That's the main demand driven for the gasoline. Therefore, given these two factors over the next 3 to 4 months, we expect the gasoline spread over Dubai to gradually recover from the trough. And now I think gasoline is already moving up and also together with the refinery margin or the GRM. For the second product, the middle distillate, the diesel and the jet fuel, I would say that on the fundamental side, diesel and jet fuel fundamentally is quite firm. For example, on the demand side, and this year we expect the global diesel and jet fuel demand still growing at least 0.5 million barrels per day year on year. In addition, I think what the market worries is the Chinese export. It actually will increase this year compared to last year, but the incremental Chinese export will be offset by the lower Indian export due to the local demand growth in India. Therefore, in general, the supply for the diesel and jet fuel is still quite limited while the demand is still growing. So we expect the diesel and jet fuel spread to still perform pretty well this year. And if we put everything into of the fundamentally demand the supply of the refinery, I think this chart will wrap up everything. This chart will basically cover Asia Pacific plus the Middle East, and the black dot is the net capacity addition, while the blue shaded behind is the additional demand. So the key point is that the additional demand is still higher than the net capacity addition. So that's why in general, fundamentally, refinery margin still perform very well, except in the short term for the past couple of months due to the seasonal factors. But other than that, we expect the refinery margin to gradually recover and still at a good level. And in terms of the oil demand for Thai oil, as the main product we sell in the local market around 85%. So in terms of the oil demand in Thailand, things still growing pretty well. Last year, overall oil demand is growing almost 3%, mainly driven by the jet fuel and also the gasoline. Moving on to the next industry on the aromatics or the petchem. So the two main product that we are producing from Thai oil is the paraxylene or the PX and also benzene. If you look at the indicative product spread Q1 to date, you can see that for the PX still above $500 per ton, still pretty high compared to the historical level. And I would say that this high PX margin will last at least until the mid of the year due to the limited capacity addition while the demand is still growing. And this strong PX spread will outweigh or more than offset the softened benzene. Therefore, in general, the aromatics margin still quite okay for Thai oil. But I think the only risk factor or the headwind that remain to be seen is the capacity addition that we expect to start up in the second half of this year. If you look at the figure A, you can see that first half capacity addition, even though there's some capacity addition, but the level is still quite limited. But the second half, there will be more capacity addition, especially from China. And we have to keep an eye on this plan. If everything come up online, then there could be a headwind for the PX margin. Otherwise, if there is some delay, then the PX margin could stay at this level throughout the year. So we have to monitor this plan start up, and we will keep update to you for the next opportunity there as well. And for the benzene, I think the key figure is look at the figure A. Capacity addition is more or less quite equal first half and the second half, and we expect the benzene margin to quite stable this year. So I think that the factor to look at is the PX. If the PX actually is still at a good level, it will continue to pressure the benzene because all the PX plants still maximize run, and benzene is the byproduct that's coming out, and it will pressure the benzene spread. But overall, given the very good PX spread, it will more than offset this weak benzene, and that's what's happening right now. Strong PX and weak benzene, but overall, the aromatics margin is still quite okay. And last industry that we operate is the base oil and bitumen. For the base oil, you can see that Q to date, the margin constantly coming down from the end of last year, and it mainly pressured by the new capacity coming in the figure 1. And I think in general, we expect the base oil contribution this year to be slightly softened compared to last year, given the new capacity addition, and all of which already reflected in the current spread that we see. And another product from the base oil complex is the bitumen, which is more or less the byproduct that we sell. In general, the margin is quite stable, negative around $40 to $50 per ton. That's on the margin side, but on the demand side, demand for the bitumen that's used for the road construction still growing pretty well, especially in Thailand and in this region, given due to the strong infrastructure investment in terms of the road construction. So in terms of the sales, no problem for the bitumen demand. Only the margin that's still a bit negative compared to the feedstock cost. But given the positive the base oil spread, so overall that the base oil complex still contribute to the group margin at least 30 to 40 cents per barrel. Might be lower than a previous year, but still making some money to the group. And lastly, this is the kind of chemical product that we upgrade from the benzene that we are producing. So basically, this is the LAB product that further used by our customer to produce the detergent. And for the LAB spread, you can look at on the left-hand side that the spread is more or less quite stable, around $500 to $600 per ton. And in terms of the sales, demand for the base oil is still growing, tracking the GDP around 3 to 4% per annum. And the good thing is that this year, quite limited capacity addition for the base oil, for the LAB. Therefore, we expect the LAB contribution to stay at this level, around 30 cents per barrel, and the outlook is quite stable. So in terms of the conclusion for the market outlook, for the crude oil, we expect the crude oil price to recover from the end of last year, given more tightened market, especially on the supply side. On the refinery, we also expect the refinery margin to already pass the trough and will recover. As you can see from the Singapore market, Singapore benchmark refinery margin, the trough is around $2 per barrel, and now it's moving back to around $4 per barrel. And we expect the recovery to continue because we are about to enter the refinery maintenance season globally from March until June, and that will limit the supply in the market, and that will support the recovery of the refinery margin at least until the mid of the year. And for the aromatics market, right now the PX margin still very firm, above $500 per ton, and we expect to continue at least until the mid of the year as well. due to the limited capacity addition, and that will outweigh the softened benzene market. For the base oil, to be honest, is a bit softened right now compared to last year, given the new capacity coming in. But the good thing is that lower than this, it will hit the other base oil plant in terms of the cash cost. So in terms of the downside, it should be limited already for the base oil. And lastly, on the LAB, we expect a quite stable market given no capacity addition this year, while the margin itself is also quite stable, around $500 to $600 per ton. So in terms of the contribution, it more or less should be quite stable compared to last year. I think that's the overall presentation for Thai oil, and we have some questions that we will go through.
I will start to answer the first question. We have the question about the fundraising. As I mentioned about the CFP project that we will gonna use the investment. We have the investment around 4.8 billion, and that one we already for the funding that amount. Actually, we have already fund around 1 billion last year. So now we have around 3 billion in our pocket to prepare to pay for the capex. And for the next 4 years during the construction, we expect that we have the operation cash flow in is around 400 million. Yes, that's come from the operation after deduct the dividend payment. So for 4 years is around 1.6 or almost 2 billion that come in the next 4 years. That we plan for the fundraising for the CFP project. And for the capex for this year and next year, mostly we spend money on the CFP project that you can see in the slide. For this year, next year, around 65% of the capex is spent on the CFP in the yellow highlight. It's around 3.2 billion for this year and next year. And for the rest of 35%, we will spend in the next 2 years after that, before COD the project. And
I think that other question about how relating between the net profit and the current oil price. I would say that for Thai oil, typically because Thai oil we run quite stable, around 110-115%, if we don't have any maintenance. And given that kind of run rate, we have the oil inventory all the time around 9 to 10 million barrels. Around 60 to 70% is mandatory by the government under the legal reserve, and the rest is the working stock. So how relate to the net profit? Because the stock is more or less quite stable, let's say around 9 million barrels. So if the oil price up and down, let's say oil price increased from 57 at the end of last year, increased to $65 per barrel today, increased around $8 per barrel. So you can look at this price differential, $8 per barrel, and multiply with 9 million barrels, which is the inventory that we have. That could be the level of the stock gain that we potentially can have. And it is vice versa. If the oil price collapse, then it will be the stock loss. I think that could be the simple calculation that you can look at for Thai oil. And another question, how to uplift sales volume and reserve. I think in terms of the sales volume for Thai oil, to be honest, we already run flat out. For example, last year we ran like 113% on average. So the room to increase the run is going to be quite limited as well. In addition, this year, in the mid of the year, we have the major maintenance for the CDU number 3, around 40 days. So the run rate on average will be reduced around 10% from last year. And in terms of the reserve, I think it's kind of required by the government. So other than that, I think we try to minimize all the inventory. We would like to sell everything out, so only a few portions that we hold as the reserve. And mainly for Thai oil, we hold the reserve on the crude, not on the product. And another question, potential to increase the dividend payout. As you can see, this year we marginally raised the payout from 48% increase to 53% this year. But going forward, I would say that given the capex on hand, especially from the CFP, then I would say that the board of director and the management, I think we plan to at least maintain the payout around 45% plus or minus, despite the heavy investment that we have, and also despite the dividend policy minimum 25%. But we will try to maintain at least what we paid in the past, around 45% plus or minus. And another question, the breakdown, could you please break down the margin from overseas? I think that if we look at the key business of Thai Oil, the refinery, we sell the local market around 85%. And the 15% we export. And look at that 15% export. Most of them, around 10% we export to Indo-China market, which is the Cambodia, Laos, and Myanmar. And only 5% that we export to other market, or mainly Singapore. I think that's kind of the key breakup of the sales pattern. And in terms of the margin, I would say that the local and Indo-China market, typically we command more premium compared to we export to Singapore, given the price structure. I think that's all the question that we have. Yeah, I think that's all for the Q4 and full year 2018 presentation this year from Thai Oil. Thank you so much for your attention.